Florian, thank you very much for coming on here today. I really appreciate you taking the time to sit down with me. I really want to pick your brain on a few things. So I think the best way to start, as with most interviews, is a little bit of a background on yourself and Midas Touch, sort of the focus of the company and sort of the intent there with the information that you provide. If you could give me a bit of a summary, I'd really appreciate it.
Sure. First of all, thanks for having me, Taylor. I appreciate it. I came into the world of finances as a young man. I would say I was, 20 years when I bought my first stock, somewhere around 1995. I had zero clue about the financial markets. I made this decision on myself, and I basically was very lucky with my first stock because it went up 10 times in the internet boom of the late 90s. And when I intuitively wanted to sell it, back then you had to go to your bank and basically physically speak with the people on the desk, and then they basically would take your order. And when I went there and basically told the guy I would like to sell this big gain that I had, and it was, for my young years back then, it was a lot of money. And the guy talked me out of it. So the banker basically said, no, it's better if you wait. There's going to be this conference, and don't sell now. I'm sure it's going to be higher. And so obviously, I still don't understand how I was able intuitively to pick the top without having any knowledge of the markets. But somehow the sentiment was very obvious back then that everybody was very, very excited about the internet stocks, euphoria everywhere. And I obviously followed the advice of the banker and didn't sell. And back then you couldn't check the latest price of the stock in the internet, right? You basically either would go to video text or would read it in the newspaper. And so I waited, and probably a few weeks later checked again, and obviously the price had fallen. It was trading way below 100 where I wanted to sell. So, and what happens then is this psychological pattern where you then basically tell yourself, oh no, it was at 100 now, I'm not selling. And you keep watching how it basically moves lower. And I basically managed to give back most of the gains that I had accumulated.
Wonderful.
Which was a very painful experience. And that, together with the fact that I then was very successful with my normal business, which was I'm a music producer and managed to be involved in a few number one hits in Germany back in the late 90s, early 2000s. And suddenly had some money to take care of. And again, another banker gave me the feeling they had no clue what they were talking about. Were only pushing products on me, calling me every week, Mr. Grummes, we have something very special for you. They have to push product on me, but I never had the feeling this guy really knows what he's talking about. And watching after the internet crash going down every month, while they charged me commissions and fees for just having the portfolio with them, I came to the conclusion that I had to change it and really needed to take this in my own hands. And that's basically when it all started. I remembered my grandfather. He died 3 months after my birth in 1975, but he had left a letter with me with a rare gold coin where he wrote that this should be the foundation of my future wealth. And so I was rather open-minded towards precious metals around 2001, 2002. And started to buy a few coins on eBay because there were no bullion dealers back then in Germany anymore. They had all shut down because after this 20-year bear market in the 80s and 90s, there was no interest in precious metals. So that's how I started getting into precious metals then. And obviously, once you start buying gold and you hold the coin in your hand, you somehow get the feeling like there is something more to it. And then you see, usually there's a king or some historical information on those coins, right? And so that sparked my interest. And then, the following years, I spent every free minute on educating myself about trading and investing in the markets, and especially always with the focus on precious metals. And also commodities. And once you go down that rabbit hole, it's in the end about freedom. It's in the end about becoming self-responsible also for your investments, and understanding that the fiat money systems in the world has always been creating disaster for the people in the end of the day. And then if you go further, you end up with Austrian economics, you end up with Ludwig von Mises, and then it was not difficult to be very open-minded when Bitcoin came around. And I heard of it the first time, I think, in 2010, and then 2012 and 13, I really looked into it and started also buying some. And basically the rest is history, because Midas Touch Consulting was born out of the wish to, first of all, learn for myself and become a better trader and investor, and then also help other people. And nowadays, Midas Touch is focusing on those two sectors, on precious metals and cryptocurrencies, because that's basically the two asset classes outside of the traditional legacy fiat money system. Mm-hmm. And I believe that probably the best ways that people can protect themselves nowadays. Obviously, also over the last few years, they have been the best performing asset classes as well.
Absolutely. You've gone ahead and answered one of the questions I had for you, which was sort of given the focus you have on gold and silver, precious metals in general, and cryptocurrency. I'm guessing you are interested in the term sound money, or at the very least systems hedging against fiat, just being able to protect yourself and protect your wealth.
Exactly. You're absolutely right.
We've seen incredible volatility in the gold market in the last few weeks, and sort of starting to run up, breaking some trends. And I'd love to get your perspective on where you think we're sort of looking mid to long term.
Right. It's very important always to make this distinction about which time frame we're talking. Right.
Exactly right.
Markets can do lots of things in the short and the mid and the long term, and they can actually be contradictory if you not make it clear which time frame you're talking about. So
exactly.
I think if we first maybe talk about the most recent price action, it's important to understand we had 3 times a test of the 1678, 1680-ish kind of level last year.
Yeah.
3 times. And the last time gold went to that number was in this crazy flash crash, I think the 9th of August last year, when the Asian markets suddenly opened $150 lower. But that was the low. And since then, gold has been climbing higher. Initially, until basically mid of December, it was not so obvious, and it was rather a slow grinding kind of move higher. Then you had a few spikes, and then it came also quickly back. It was actually very frustrating time for most of the gold bucks. But since mid of December, basically a new, more obvious uptrend has embarked. And then especially since end of January, we've seen this massive run higher, especially driven by the Russian invasion in Ukraine, right? I think that has been a big driver, obviously. But it is what it is. Gold nearly reached its all-time high at 2,075. It just fell short of $5, I think. And then quickly over the last 7-8 days, we've seen a big pullback of nearly $175 already. So it's a very volatile market at the moment. And it's very news-driven. It's a very emotional market. Gold anyway is always a very emotional market. And so obviously it all depends on how this whole thing in the Ukraine is playing out in the short to midterm. Mm-hmm. But in the bigger picture, I think that gold is working on this cup and handle kind of formation. Yeah. And all that it takes now is that it breaks above 2070 again. And then I think it can quickly run much higher. And my projection out of this cup and handle pattern that gold has been actually building over the last 11 years, because the top in 2011, it took 10 years to come back to this $19.20 kind of range. So if gold breaks out above this all-time high, 2075, 2070, then I think we probably go rather quickly within, let's say, a year or 1.5 years towards $3,500, maybe even $5,000. Because then it's really sky is the limit once we clear that resistance zone. The only problem that I have in the short term is, besides that it's such a news-driven market right now, is we are rather overbought on the weekly chart. The commitment of trades do not look so well anymore. So I think until the summer, I would be, and that would be the midterm kind of outlook, I would be a little bit cautious here. And I really need to see that gold can break through this massive resistance that it still has around the $2,000 to $2,075. And I wouldn't be surprised if we see another round of consolidation. But again, this is all connected with how this situation in the Ukraine is playing out. If they basically find a way to have peace and calm down the whole situation, I think then gold will also strongly correct, actually.
I guess that leads quite well into another question I had, actually, which is that compared to previous periods of sort of nationalized economic instability, what we're looking at now does feel a lot more global. And so considering things like gold and Bitcoin, obviously, from your perspective, what are those key risk management strategies that you want to employ?
Yeah, it depends, obviously, first of all, on yourself, on who you are in terms of, are you an investor? Are you only buy and hold? Are you maybe also a trader? How much experience do you have? How much money do you have? How much risk are you willing to take? So these are all very individual questions already. But a general, always good answer to it is stay away from too much trading, stay away from paper gold, buy the physical stuff, make sure that it's either in your own hand or that you have sorted with somebody that you can absolutely trust and will access when you need it. I think that already is a very basic and very important distinction. It's nothing new. You also know, I think at the COMEX, there's probably trading 200 paper ounces of gold for every physical ounce of gold. So, and we've just recently seen it in the nickel market. What can happen if something suddenly there's a crazy move, there's an unexpected move, and somebody has to show up with the physical material. If you are leveraged long gold in the paper gold market, maybe they will pay you out in dollars, but maybe your counterparty basically goes bankrupt. Maybe they cannot come up with paying you anymore. So the whole idea of what gold actually is as a safe haven and a store of wealth and sound money is basically violated if you trade paper gold, right? Then you are a trader, you're a speculator, which is fine if you have the experience. You have to understand that the gold market is a very tricky market. It's a very difficult market. It's a political metal, so there's lots of different interests in this market. So usually I would say stay away from trading too much. Focus on accumulating physical gold and silver. That's the much easier way. Maybe it's not as exciting and fancy in terms of returns, but that's why I also say make sure that you not only have gold, but also Bitcoin, because that's where you basically have maybe, of course, you have much more volatility, but you can also have much larger returns. The security or the wealth preservation that gold and silver do offer are unbelievably great, and it's really, I think, an essential part in nowadays in any portfolio. And I always said that at least 5 to 10% of your net worth should be in gold and silver.
It is one of those things where, as your grandfather was able to do, you can take the actual product, the actual coin, and you can give it to your son or to your grandson. You can pass it down in that sort of dynastic, sort of intergenerational wealth way. It facilitates that transfer of wealth through time. And the paper contracts, as you say, with the counterparty risk being basically wide open, it really doesn't have that same guarantee and that same ability to know that you're going to be able to hand them the coin, because you're not guaranteed to be able to take that physical delivery. I think with what we're touching on there, with regards to market stability through time, I was listening to an interview you were doing the other day, actually, and the term "crack up boom" got thrown around a little bit. I think I understand it, but for my own benefit and hopefully for some of our readers and listeners, I'd love for you to just give me explain it like I'm 5 years old, kind of help me understand the crack up boom from that, like, the actual stages of it and what to sort of expect if that is what played out.
Yes. Well, the crack up boom is basically a term that was phrased by the founding father of the Austrian School of Economics, Ludwig von Mises. And it basically describes an economic crisis that involves a recession in the real economy and at the same time a collapse of the monetary system. And that is due to the continual credit expansion and the therefore resulting unsustainable rapid price increases. Mm-hmm. So that's basically the definition of it. And the crack-up boom is characterized by two key features. So on the one hand, you have excessively expansionary monetary policy, which then leads to out-of-control inflation expectations. And the second part of the characterization is, in the end of the day, and that's a process over probably many years. Mm-hmm. It's not happening from today to tomorrow within a day or two. But the result is a hyperinflation, or at least a superinflation, which ends in the abandonment of the currency by the market participants, and simultaneously leads to a recession or even a depression. And if we look at those characteristics, so I think we can both agree that we have excessive expansionary monetary policy in place all over the world.
Yes.
Not only the Federal Reserve and the European Central Bank. I know that the Indians, the Chinese, the Australians, South Africans, the British, every central bank,
everyone
expanding their balance sheets by creating money out of thin air. We can have a nice discussion how much it really affects and how much this is really money printing, but the money is there in the system and it gives a signal to the participants in the economy. So, and since the Corona crash 2 years ago, there is like more than a quarter of all the dollars in existence have been created since then, right? Since then. So there's no discussion that we have a very expansive monetary policy all over the world. And at the same time, you have to understand that inflation is also a psychological phenomenon. Once you see that prices are rising, you are not, as a business, you're not willing to lower your prices anymore. So it's logic that you will say, no, gas prices going up, we cannot lower. We have to lower it. We have to increase our prices as well. Mm-hmm. If you are a consumer and you see like, oh my God, we have inflation, things are rising. I know that I want to buy a car, or I know that I want to buy a bed. Maybe it's better to buy it now than in a year because it will probably be much more expensive. Mm-hmm. So these are the psychological phenomena that are happening. And then the more the prices are rising, the more everybody's getting trapped into that kind of wheel. And that's well. I mean, I just yesterday read that a big company, a big agricultural producer here, they basically publicly announced, look, this is now the prices we have to pay for gas. We have 30 big transporters. The company will have to pay more than 250,000 euros more every month just for the transportation of our vessels. So we have to increase prices. Don't be surprised if you will have to pay much more for the eggs and the agricultural foods in the supermarket. And obviously, now what's going to happen is people, the consumers, are like, oh, maybe it's better to buy some more coffee now because maybe after a year it will be more expensive. Okay, so then that again increases the demand. And of course, at the same time with this lockdowns, we had also a lot of supply issues. So this whole wheel, or it is basically started, and now I believe it's going to be very difficult to put that back into the box, and especially now with Russia being responsible for so many different commodities. I mean, here in Germany, if we don't get the Russian oil and gas, especially Eastern Germany, will be freezing in the next winter because we don't have enough energy here. It's impossible. And this idea of moving a society away from fossil fuels to a green electricity-backed energy is unrealistic to be happening within a few years. This will take 10, 20, 30 years. And most of these people have zero understanding how much commodities we will need in terms of copper, lithium, cobalt, nickel, et cetera, et cetera.
To actually produce that, the hardware and the full infrastructure around that kind of energy production.
Exactly. And so this will be another factor down the road that will push inflation expectations even higher. And so the cracker boom, in the end of the day, basically means that you look at the stock market is going up, but it doesn't feel good.
No.
And it doesn't feel like, and I can tell you this from, I started telling you about my experience 25 years ago, and like the late 90s, early 2000s, the sentiment in society was a completely different one. You cannot compare it anymore.
No.
People are having a hard time nowadays. And it's not probably going to be better with these rising prices now everywhere. So the cracker boom is, you see the stock market going up, but it actually is not reflecting a real boom, but more like a catastrophic boom. It's only driven because people trying to figure out where can I put the fiat money that I have and make sure that somehow I manage to keep the purchasing power.
Yeah, outrunning the inflation, so to say.
At least. If you manage that already, I mean, that's already a difficult task now.
Yeah.
Because yes, markets have been overall going up over the last few years, but you not only need to make, and I mean, this is the official numbers, like 7 to 8% inflation.
Yeah.
The guy from Shadow Stats comes up with 15%, and I think that's much more realistic. So let's say you need to make 15% inflation to keep up with inflation. Then they will tax you. So that's needs to be also in your calculation. And so I think you would have to make at least 20% every year, and that's already very challenging for most of the people.
That's a very difficult percent to hit. Certainly on a consistent basis.
Exactly.
Less difficult in some of the crypto markets, but also they go down as much as they go up. So it's hit or miss. Just back to with the technical sort of makeup of that crack up boom. Thank you for explaining that. I had another question in there, I suppose, that came to mind, which pertains to velocity, the velocity of the money. And as you say, and as we know, I suppose that expansion of the money supply has been pretty severe. you might say. But in the midst of all of that expansion of the money supply, we have had COVID, and we've had restrictions on travel and restrictions on tourism and spending in general. I was looking at a report the other day, and it said, this is for here in Australia, almost all of the money that otherwise would have been spent on travel or holidaying over this last 2 years, the sort of COVID period, has been pushed into almost exclusively into housing and real estate. And I'd be interested to know your thoughts around the change in money velocity that we're likely to see as lockdowns go away and as economies open up in more the sense that we've been used to them over the last sort of 15 to 20 years. What's that technical aspect, the technical impact of increased money velocity in an environment of expanded monetary base? So we haven't had much money velocity. It's sort of all been sitting in places. Sure, it's gone into very static stuff like real estate. But as we see money moving around, in particular, as you say, with inflationary pressures, people are incentivized to spend now rather than save and spend later. That velocity piece can be quite impactful on what happens and getting us to that hyperinflation state.
I agree. I mean, I'm not saying that we are in front of hyperinflation, but I think that this is the final outcome, right? And this could still take a few more years at least. And it's you make an important point. Yes, I think this inflation, right, that we are now experiencing. The reason obviously was also the lockdowns and the problems in logistics and supply chain problems or issues. That basically started the whole thing, coupled with the massive expansion of the monetary base. But exactly, if now the lockdowns are stopping and people are kind of like going back to normal, they want to catch up with everything. And I mean, this can, as you rightly pointed out, push the money velocity massively up within a very short period of time, because I know that many people have been suffering the last few years, sitting at home, and they desperately wait to travel around and to do things, right? So it's absolutely right. At the same time, I can see already that prices have been going through the roof. If you look at hotels and traveling, plane tickets, it's pretty crazy, honestly. Mm-hmm. And I wonder how this all will play out. There is certainly at some point also a self-regulating component in it. If prices go too much through the roof, then people will not consume that much anymore. But then again, I don't think we're there at the moment. I think, I mean, I'm expecting double-digit inflation rates rather sooner than later. Official ones.
Official ones, yes. That leads into the last question I really wanted to pick your brain on. It's specific to risk management and position sizing. And this is something that I've learned the lesson the harder way from time to time, making, the markets whipping you around the back of the ears and reminding you to be patient with positions. As we sort of go forward and we face this inflationary pressure, we face the impact of changes in monetary velocity and just the general uncertainty that we seem to be dealing with in the markets globally. I'd like to get a few points from you about how do you determine position sizing in a portfolio, and what sort of strategies do you have in place for patient and prudent trading?
Yeah, this also, there's a few individual parts to it, and there are some general principle-based parts to it, right? And the main principle how you can make money in the markets is that you have to buy low and sell high. And
I've been doing it all wrong.
and obviously that is true for all time frames.
Mm-hmm.
And again, it's again a very easy statement, yet it is very hard in reality. And to understand how it works, you need to figure out the time frame that you are yourself operating in. If you're a day trader looking at a 1 minute chart, you have a different understanding of what is high and low than if you're a long-term investor and you're looking at weekly or monthly charts, right? Mm-hmm. So that's already a very important understanding. The key to your success is understanding yourself. What do you want to do, and in which time frame do you feel well? I mean, if you are let's say you are you have to go to an office every day 9 to 5, and you have 2 kids and a family. Obviously, you cannot be a day trader, right? But I've seen a lot of people who still kind of like put on trades in during their work day, and then wondering why they're completely blowing up the account. So, this doesn't work, right? You have to figure out what really fits to me, and this is a psychological question. It's also a question in terms of what kind of like risk appetite do you have, or how risk averse are you? That also is a question: how much time do you have? How much? What's going on around you? These are all very basic questions that people have to answer for themselves. And most of the time, the right answer is, okay, I can only be a long-term investor and maybe add some kind of swing trading to my portfolio, meaning maybe I do some positions that I have to hold for a few weeks or months, but like in and out in a few hours or a few days is probably not the right approach. So that's already the clarity. And then if you know that, then you need to figure out, like, how can I find out if the market is high or low that I'm looking at? And I personally like to use charts for it. There's oscillators and indicators that help you to figure out, is the market rather high or low? And the best way to figure it out is obviously sentiment. However, you don't get a lot of signals. So just a week ago, sentiment gave a clear buy signal for the stock markets, because fear was extremely high due to the Russian invasion. And the dump money was extremely basically on the sell side, while the smart money was starting to pick up positions. So sentiment analysis is actually beautiful for figuring out when to buy high and low, but it only works if you have a mid to long-term approach, right? If for day it's not helpful. So that's one thing. Then you asked about the position sizing, and if you keep the general rule that none of your positions should be larger than, or the risk in the positions should not be larger than 1% in each position, right? So let's say you buy a stock at 10 and you decide, okay, I accept that my idea was wrong and the market did something different. If the stock drops below 7, I'm out. So I'm risking $3, 30%. And now, if I buy one stock and I risk 30% on each stock, how big can the whole position be? And then you have to figure out, what's my total portfolio? I will only risk 1% of it. And then you know how much stocks you can buy. So let's say, let's keep it simple and do the numbers. Let's say you have $100,000 in your account and you're willing to only risk 1% on each position. You can risk $1,000 on each position. Now, in our example, you buy the stock at 10, you say at 7, there is a stop, I'm out. I risk 30% or $3. We said on the total portfolio, you risk $1,000. On one stock, you would risk $3. So that means you can buy 333 stocks at $10 or at $7, and you will never lose more than $1,000, right? That's basically how you calculate your position sizing. And then and that's actually much more important than figuring out when and what to trade. It's the exits, right? When you sell, that's where you basically make the money or lose the money. And we have this quad exit strategy, which is you basically scale out of your position. You're not to one sell completely, but you sell first 50%, then you sell another 25%, and then the last 25% you try to hold as long as possible, because nobody knows what the markets are going to do. Future is completely open. And if you catch a nice trend, this last 25% become a real home run. So, and on the way to those last 25%, you have already taken out first the 50%. That means, let's say in our example, you bought at 10 and you decide at 12 or at 13, I take 50% out of the position. The remaining position is de-risked. It's much easier now to manage that position, because what you actually paid for the remaining position is much lower than the initial $10 that you paid, because you took money out of it already. And psychology is the most important part of your investment and trading process. And once you are in a position, psychologically speaking, at ease and much more relaxed and patient, suddenly everything's becoming much easier. So that's why it's first 50%, and then you take another 25% in our example, maybe let's say 16 or 17. And then the last 25%, you nearly paid nothing for that position. The break even is so far away that you can give a lot of room to the market to let it breathe. And if you're lucky and you are in the right in the right trend direction, this thing can march much higher, and that will give you basically that patience. Or the ability to be that patient and let that stock run to $30, $40, $50, because you cannot lose anymore. You've been a winner already, and you've taken out all the risk. So that's something that I learned over the years is very helpful in terms of managing the trade and managing.
I think that's fantastic advice, particularly for younger traders or newer traders. That de-risking of individual positions goes a long way, and there's something that I've definitely learnt that lesson here or there. But I think that idea of maintaining your sort of capital pool is a good point to focus on. It's, growing it is easier if you're not constantly losing chunks of it.
Of course, there's not much more things to say, right?
Of course.
I give some more like principle-based answers towards position sizing and risk management. Of course, I think especially nowadays, people can see how important it is to have a diversified portfolio. A year ago, your tech stocks and your cryptos went through the roof, and you were basically giving up on your precious metals. Now, half a year later, commodities, oil, and precious metals are going through the roof, and everybody who has them is grateful for it, because the stocks and cryptos have been going down a lot over the last few months. That's the idea of a diversification, right? And I think that's a very, very important part. But you also have to understand, going back to the crack-up boom, I think we are in a commodity super cycle, and that we're going to see much higher commodity prices over the next few years. So it's really important to have that exposure into the precious metals and the commodities. And the first step, in my opinion, always is to have exposure to physical gold and silver. And then in the second and third step, you can think about maybe adding some mining stocks or companies that are in the commodity space. And I mean, there is still unbelievable big companies like Rio Tinto or BHP Billiton. They pay really big dividends. Also in the oil sector, you still find companies with like unbelievable big dividends every year. So that's also one of the ideas that I follow for the last 2-3 years, building a commodity blue chip portfolio that pays nice dividends, where you're not trading out, but you keep and hold them for at least a few years.
Yeah, fantastic advice. Florian, for our listeners, if they want to get in touch with you or see more of your content, Midas Touch Consulting is your business and your website. On Twitter, just they can follow you there. Just what's your handle and any other ways that they can best reach out to you?
Yes, I mean, we have a website where we publish weekly chart books for gold, silver, and Bitcoin. We have daily calls for gold, silver, and Bitcoin that helps more like the traders. And we have a nice Telegram channel where people can join us. It's all free, and it's a great community of like-minded investors and traders from all over the world. It's kind of like a mastermind group where we really help each other. And I'd love to see people joining there. Also, obviously, we are on Twitter, and we have a newsletter going out once a week, with basically a summary of our publications.
Absolutely fantastic, Florian. I'll definitely be jumping into your Telegram group. I'll send you some messages in there. Thank you so much for your time today. I greatly appreciate it. I'd love to find some time in the future to talk to you again, have a little bit of a follow up and do an update and sort of see how we're going and take more of your time if I could.
Sure. Thank you. Thanks for having me.
Thank you so much. Have a wonderful day.